non-current liabilities and equity learning quiz. Questions, half a dozen questions to test your understanding of key concepts. What are the advantages to owners of a company having more debt? Debt increases financial gearing, and this can help increase returns on an owner's equity. This does lead to higher risk as the company is operating closer to its break-even point, but interest payments on debt are tax deductible, and this means up to a certain point, adding more debt increases shareholders' value. What are the constraints on having ever higher amounts of debt? More debt makes the company operate closer to its break-even point, increasing the risk of bankruptcy. As the risk of bankruptcy rises, investors require increasingly high rates of interest, so this is no longer a viable option to issue more debt. Identify the principal components of non-current liabilities. Bank loans and issued bonds, the vanilla bond portion of convertible bonds, net pension liabilities, and deferred tax liabilities. How does long-term debt financing differ between the US and the UK on the one hand, and Germany, Japan, and China on the other? In the UK and the US, the bond markets are a more important source of long-term financing for companies than banks. This is reversed in Germany, Japan, and China, where bond markets are relatively underdeveloped. Explain how net pension liabilities arise. Net pension liabilities arise when a firm has a defined benefit pension plan and the plan has a deficit. And the value is the present value of its defined benefit obligations minus the market value of the plan's assets. Identify the principal components of equity, explaining how each arises. The first one is share capital and share premium. The sum in these two accounts shows the total value of new equity that has been raised from investors. Retained earnings, total profit attributable to owners, less dividends paid out. The residual components of convertible bonds, the value of the equity component of any convertible bonds issued. And finally, treasury shares, the cost of its own shares that it has bought from the market, and this is a minus number. Explain what preference shares are and how they differ from other forms of debt. Preference shares are a form of debt. They differ from equity in that dividends may be missed, payments are usually after tax rather than tax deductible, they may be perpetual rather than having a fixed term, and they may convert to equity under certain conditions. And those are the questions that we've looked at now.